Welcome to ET India Boardroom. On this panel, we'll be discussing fintech and innovation in lending. Our panelists for today are Madhusudan, CEO of Credit B, Naveen Kukreja, CEO and co-founder Paisabazaar, Vasant Sridhar, co-founder of Business, and Manish Kumar, founder and CEO Credix. So thank you all for joining. Maybe each one of you can just take 15 seconds, introduce yourself, and I can do that in the end, and then we can start, if that's okay with all of you.
Sure. So good evening, everyone. So this is Madhusudan. I am the co-founder, CEO of Credit B. So Credit B is a fintech platform primarily serving the mid-India, middle class, mid-income segment. We offer personal loan, credit card, the card product as our primary solutions. We do have many other financial products where we are largely looking for a financial inclusion as one of our prime motive.
Thanks, Madhu.
Hi, this is Naveen Kukreja. I am the CEO and co-founder for Paisabazaar. We're the largest marketplace for credit products in the country, and we are part of PB Fintech Group.
Hi, I'm Vasant. I'm a co-founder and CSO of Business. We are India's largest B2B platform. In the last 1 year, we have also spun off one of our financial services companies called Oxizo into a full stack financial services company catering to the mid-market, SME and emerging corporate segment.
Thanks, Vasant.
Hi, this is Manish. Good evening, everyone. I'm founder and CEO of Credix. We are India's largest supply chain finance platform.
Excellent. Thank you all again for joining. Very quick introduction for myself. I'm a partner with Bain & Company. I lead our financial services practice. I actually have met some of you, have worked with some others. So great to be here and get connected to all of you again. Let's start the dialogue. I wanted to first get your thoughts on an Uber question. I've seen a lot of you guys talking about this. Lending is a business which has been going on since centuries, thousands of years actually. Suddenly we see lots of new things happening in India, across the world. Just wanted to get some thoughts from each of you as we begin the dialogue, and then we will go deep into some of the different verticals or sectors. But what's driving this so much emphasis on lending, the boom that we see right now? Obviously, there is a part played by technology, but good to get your thoughts. Maybe Madhu, we can start with you and then get to everyone else.
Sure, Trihan. So see, one thing is we do largely the retail loans.
Yeah.
So I'll be talking about the individual loans or the personal loan card products primarily. So as you rightly said, lending in form or other, probably it kind of dates back to about thousands of years. I think this has been happening. So as such, so what is taken the different focus for most of us who are in the digital lending space is the idea about the customer centricity, right? So, and also to serve the underserved or the underbanking segment. Just to kind of add to that particular format, it was not that the underbanked segments were not being serviced. Probably they were borrowing from local money lenders, they were borrowing from the friends and families and whatnot, but that was never appraised, or there was not much of an incentive for them in terms of their repayment behaviors was given, where there is bureau records or anything as such. So there was nothing much on the credit appraisal as such happened, because the overall data about the overall authenticity of the borrower or his regularity in terms of payments were always missing. Anyways, just put aside that particular point. Now let's look at some statistics, right? So let's take the bureaus. Bureau has a footprint of roughly about 300-400 million people, and that's about your 25-30% of the population in India, right? So what we believe, or what I believe with our internal analysis, is there are 400 million more customers in India who are like credit worthy. Maybe they are not credit worthy in the form of being eligible for a bank. What does that mean is that these guys are not subprime, but their eligibilities are smaller. Imagine this point, right? So banks today hesitate doing any loans, even let's say personal loans less than ₹1 lakh or ₹2 lakh, because the overall phygital model makes it pretty inefficient for them to kind of serve the economics, whatsoever that kind of builds in with all the physical modalities and whatnot does not make sense for banks to serve. So therefore, this particular large segment kind of gets quite underbanked or underfinanced, right? So now there is a channels, I mean, thanks to the internet penetration, thanks to all this, the mobile device penetration and how the Indian market has taken it up. Now that device becomes as one of the key channels for most of the new age lenders to kind of reach out to these customers and then kind of make them bankable with the credible lenders or a formal lending, right? So the formal lending has come out to these guys. Again, as I told, like, it's not that they were not borrowing, they were borrowing, but only thing is it was from an informal or an unorganized channel. So overall idea about formalizing their credit behaviors and their interactions with the NBFCs, banks, has taken a new trend, because that gets appraised in their bureaus and therefore they get eligible for a higher lines. They migrate from a personal loan to a home loan products and whatnot, right? So that journey is what's exciting and what I believe has given the chance for most of us digital lenders to kind of play a larger role in terms of financial inclusion as well.
Naveen, any thoughts from you before we go to Manish and Vasant?
Sure. Madhu covered some very, very relevant points. But I just wanted to go back and look at it from a contextual perspective. And we see that, you know, what's happened in India, if you look at unsecured credit, that's only about 20, 25 years old. If you look at credit bureau, that's only about 12 years old in a meaningful manner, although 15 years old. And you look at the credit penetration. I was looking at some bureau data, which said that 16 crore people right now have any active credit product, any, could be any across. So that's roughly about 11 or 12% of the population only. You look at some of the popular retail consumer products like credit cards, personal loan, that number will come down even more. So very underpenetrated. The unsecured lending through official channels is still, I mean, relatively younger. We look at the banking system and the way credit was delivered. It was a physical, slightly expensive way of delivering the product, and hence low ticket products, low volume, low value products were very, very difficult to deliver to the consumers. And then we look at what's happened over the last 5, 6, 7 years and how things are really very nicely coming together. Internet penetration started improving from 2008, 9, 10 onwards. So about 12 years now. E-commerce started to become meaningful from the last 8 to 10 years. So people really started using internet a lot more. Smartphone penetration has started in the last 7, 8 years. And that all of that has made consumers comfortable to deal on internet. And we see that, you know, globally also in mature markets, that e-commerce usually is the first industry to take off when internet becomes popular, followed by travel, followed by financial services. We've seen that from a financial services perspective, some world-class digital infrastructure has got created. Till 7, 8 years ago, there was no single digital identity. Now it sounds very unbelievable that how are we living? But that was the truth. But now almost everybody has a digital identity, which is very, very critical from a, you know, when you're trying to lend to a consumer. The internet and smartphone piece I talked about, you know, the payment, what's happened to the payment infrastructure and all of that data coming into the digital ecosystem has started to now make data available, which becomes easier for lenders to look at certain financial data. India also is very unique in the sense that more than half of the population is self-employed, and traditionally we've had issues of underreporting, vast underreporting of income by self-employed, and hence that segment has almost always been out of the credit system. And so over the last 3, 4, 5 years, but more so in the last 18 months, we see that things are coming beautifully into place. It's easier with the use of technology to give loans as low as 5,000 rupees. And Madhu is the pioneer champion of that. So I wouldn't want to say too much in that area. It's for him to speak. We've seen innovative invoice-based financing models or e-commerce transaction-based financing models in SME emerging, and there are again 2 of the panelists who will talk more deeper about that. And I think that's what's happening, that people are just finding it easier. That people are finding it easier to kind of lend at very low value, at very low cost, and
Yeah.
consumers on the other side are just very amenable to borrowing on the internet through technology.
Yeah, makes sense. And maybe that's a segue to go to Manish and Vasant. Manish, first to you, Naveen made the point around self-employed, and actually we see it in all our analysis. Maybe the biggest supply-demand gap is actually on the SME side. What are you seeing there? Obviously, you are creating a wonderful thing on the supply chain finance side. But more broadly, as you think about SMEs, what do you think is happening? What are they demanding, and how are financiers or suppliers like you responding to that?
I think so what has happened, it's mostly what used to happen is when banks and NBFCs was not used to go to this smaller chunk, and both on consumer as well as on the micro SME sides, is fundamentally because of three things: cost of acquisition, cost of underwriting, and the NPA adjusted with it, or I would say the probability of default rather than adjusted with it. Now, with the advent of technology, right, with a lot of fintechs coming into picture, digital mode of acquisition, a lot of data sources getting associated with it, I think all these three fundamental problems are getting eliminated. So I remember when I started my corporate life in Citi, and Citi Financials, we are setting up the system. We have been asked to take the system from US, the Citi business from US, and the cost of underwriting was $10. And we said, boss, we are going to give a 50,000 rupees personal loan. It's not going to work because $10 is just too detrimental. And we started building the first system, first web-based system, where we are printing checks at that time on system, because you have to be, right. And we reduced the cost to literally around 50 cents at that time. And the same system then gets implemented in Thailand, Indonesia, many places. So it's the cost of acquisition, cost of underwriting, and the probability of default is major thing which is affecting everything. Now, if I come on the SME side, a lot of times SMEs has a usual problem that mostly banks are always used to see them as a collateralized loan, right? So you have machinery, give it to me. You have home, give it to me. You have organs, give it to me. Giving other and give it to me, right? But unfortunately, if you're a growing SME, you can't grow. Your asset doesn't grow by the same speed, right? And Naveen has said an example of e-commerce. Now, e-commerce is a pretty peculiar way in terms of how it works, right? So now, for example, the Prime Day sales and the big billion day sales are coming. Every single seller on the platform is going to go 4x more than what it used to be. Now, for 4x growth that they have to do, they have to ask for working capital. Now, that working capital, now in 2 months, their asset is not going to grow 4x. It is just like the trading business that they're doing. So it's become very important for them to say that, hey, if I'm selling it to the likes of Flipkart and Amazon, or if my sell is confirmed, why can't you use that data to do it, right? And that is where a lot of these changes in the understanding of SMEs are happening, and it's benefiting everybody, right? I know, for example, in trades, the rate has crashed to like 4%, which is unheard of. I know some of the dealer distributor are actually talking about LIBOR plus minus rate, which is again like, are you kidding it? In India, LIBOR, but people are asking for LIBOR kind of a rate. So a lot of things has changed, but I think still we have way ahead to go in terms of changing the perception.
Right. Very interesting to actually, I didn't know LIBOR is starting to happen in India. Coming to Vasant, how do you think about this? You have a slightly different way than what Manish is doing, but especially as we think about Oxizo, how do you guys think about this?
Yeah. So, very theoretically, right, financial services is a very large opportunity in a developing economy like India, right? So that can only be the driver for growth. Even if you look at the stock markets today, 30-35% of the market share is to financial services companies at the end of the day, right? So headroom for growth is something that's always there in, in this space. Now, if you look at SMEs and MSMEs and mid corporates or B2B lending, right? You can categorize that into micro SME, you can categorize that to SME and more of mid-market, and the third being the larger scaled corporates, right? There are three categories there. Some cater to the micro SME, where it is not about those who don't have access to credit. It's about getting those who are unbanked into the transaction layer. What we do is we don't focus on that, but even in the scaled SME, right, more in the mid corporate or the scaled SME, anyone more than even $1 million in revenue, you'll realize that today 55% of the credit that is there in this segment, which is already banked, is by the informal channels of your trader, dealers, distributors, middlemen, a lot of supply chain credit, which is a part of lending, which indirectly or informally sort of goes to them. What is happening is, with all transactions going online, you pull out data from GST, cash transactions have completely gone out. There is so much supply chain data available, payments, ledgers, anchors, suppliers, quantums of payments made, that for us, we realized that this 55% informal lending opportunity, even to scaled SMEs and emerging corporates, with the amount of data that we have, can be replaced with formal banking coming in. And that's where we see large opportunity of supply chain backed financing to this market. And again, as Manish rightly said, for banks, it's all about asset-backed lendings, right?
Right.
Take a charge on collateral, take a charge on your shares, take a charge on your property, first charge on current assets, second charge on property. But still, there are informal channels who have, because of their way to underwrite and work with these customers, are still taking care of 55% of their requirement. And we believe that now through us, formal channels can sort of cater to that.
Yeah, very interesting. Maybe coming back to you, Madhu, and shifting focus a little bit away from SMEs to come back to the individual consumer. You see, lots of things are now offered to the individual consumer, right? You mentioned personal loans, there are credit cards, there are the Neo cards you mentioned, obviously you are doing that as well. There is a line of credit, there could be credit on UPI and so on. There's just a plethora of options for the consumer. What does the consumer really need? It's essentially consumer or consumption financing, right? How do you think this market is evolving? And maybe the answer differs by segment, but good to get your thoughts. What are you doing and how are you seeing the market? You are on mute, Madhu.
Sorry about that. So yeah, it's a very interesting question, Saurabh. So the idea here is that, so the way the customer looks at the credit today is it's not just the cash, the transfer to his bank account, but also availability of the credit at every facets of his consumption. Right. So customer would be basically shopping on a Flipkart, or he could be doing something on a Swiggy, or he might go and basically utilize the cash for medical emergencies, or he wants to buy something like a sofa set or a TV to his house. So there are multiple needs. A middle class family, which is largely driven in India, right? So the middle class is what is getting empowered, and therefore it's a growing economy. Therefore, credit is one of the raw material for such a growing economy. Now, the idea is that the consumption of that credit is at a multi-dimensional way. Right. So now, therefore, the entire specificity in terms of how to provide the credit line at what at the customer interaction level becomes very important. So today you talked about there's a personal loan, there is a card products, there are OD lines, credit based on UPI and whatnot. Now, if you look at that, what basically is happening is these were all the services, some form or the other, it was provided by a bank. And since the bank was providing all the products, probably there was no specific focus on each of these products. So what the fintechs have done is carved out each of them and then started specializing on each of that particular product, and then building a multi-billion businesses over on top of that. Right. So now if you look at that, then we are dividing and then making every product as efficient to deliver, and then as so as easy to consume is what the focus has been. That's one thought. The second thought is that the guys who have specialized on one line of product are now looking to specialize on multiple more products, and then probably looking for an unification depending on their scale and whatsoever. Right. So these are the two thoughts in how the fintechs are today evolving. And my personal thought is the way we look at it internally is to surround the products around the customer. Right. So what not to forget here is that there are different class and segments of customers also come in. Right. So that's the next level of thought, right? The next dimension to add to whether you want to be a unified super app or you want to be a specific one service providing app. While that is there, then comes the segments. There is a metro, super prime, salaried customer versus self-employed customers versus non-metro, tier 1, tier 2 customers. So there are different customers, and every customer does not require the probably the way to serve them would be very different when we look at the customer segment. So then further division happens in terms of, if I am providing for mid-India, then whether I should go for the metro customer, or somebody is like looking for the metro customer, whether they should kind of go deep into different customer segments, right? So all in all, the way I put it is that one is either I become a, the idea is to kind of specialize on one single product and look at further different customer segments, and then I kind of grow on that, or I want to unify different products for the same customer segment and become a super service provider for that segment, right? So these are the evolutions, what I see in terms of how the retail fintechs would look at.
Makes sense. And maybe Naveen, good to get you in here. You work with both, players like Madhu as well as some of the traditional banks and NBFCs. How do you think the traditional banks and NBFCs are thinking about this opportunity? Is this broadly in line with how Madhu described, or they are thinking something different, or they might come to this stage? How do you think that is evolving?
Okay, sure. So I think traditionally the below prime segment has never been developed well by banks and NBFCs, because if you think about it, most of them are public limited companies, and most of them have been, because the credit was so underpenetrated, they were very easily growing at 15-20% per annum by staying within prime. Also because the credit bureau itself was new, if we go back to pre-global financial crisis, etc. And the credit bureau maturity awareness has just started to come in the last 5, 7, 8 years. And hence they didn't feel an immediate need to go to this segment. And also the technology, etc. did not allow them to very easily go at a very low cost. What's happened now is that I think especially from what the banks and NBFCs have seen, that has happened in the payment ecosystem, where the entire payment front end has, especially on UPI, has almost all of it has gone to the fintechs. They are there in the back end, but the front end is fintechs. You see now it's happening in the second category, that equity investment we've seen over the last 2 years, almost 70% or so, I think, of the new customers are going or being acquired by the fintechs, and the bank-led brokers are, at least in new acquisitions, are behind. So they are very, very aware of the challenge that lies ahead of them, and they're also aware of the opportunity. Where they are more conservative and conscious is that I think any subprime pilots that they have done, and it may be a timing bias, which was done mostly, let's say, a few years ago. They have burned their hands. They include pioneers like Citibank, ICICI Bank. All of them have burned their hands in that. So they'll be very careful entering into these segments, entering into very new formats. But they're very smart people, very smart companies. I think over a period of time, what's happening is, as cost of delivering product becomes cheaper, they're realizing that there will be different. There's a huge demand supply gap. So there'll be different formats of products that will emerge. They will need to bring down their cost to deliver smaller ticket products. They will, I think in certain segments, their strategy seems to be that they will wait for the new fintech players to grow the market, make it, get it to partly cook it, as they may say it. And then they'll say that we have the largest muscle and the lowest cost of funds. So now we'll also come and enjoy the party. I think that will definitely happen. And what might also happen in the bank's favor is that the public markets and the analysts might get more comfortable with the fact, with the term called risk-based premium. And if the risk is higher and the margin is higher, all of that is also a good segment to do that. Currently, I think they've also hesitated in that because NP as a single metric can spook the market if that goes above a certain level. But I believe the innovation will continue to be led by the fintechs, and they will really help in developing the next 100 million, if we could call them, consumers who will be eligible for financialization in credit. Of course, banks will come and take their spoils also, but some of the fintechs who do well will continue to survive and grow.
Right. And maybe just picking on one thing that Naveen mentioned, Manish and Vasan, now coming to you, is essentially, and you guys earlier mentioned, shifting at least on the SME side from a secured financing to much more cash flow based or invoice discounting, right? So especially as you move there, the one concern that Naveen mentioned that banks had was around cost of credit. Now, as you are creating newer models, two questions: how do you see cost of credit evolving in the SME space in particular? Point number one, and point number two is just how do you, because the SMEs need a lot of different products. So in some sense, they are coming to you for something. They obviously have a current account with the banks and so on and so forth. So how do you think about share of wallet in those consumers as you serve them more and more? Manish, maybe we start with you and go to Vasant.
Sure. So sort of, no, fundamentally, and this is what I tell it within the team, is what we are selling is money, right? And money doesn't have any other shape and sizes. It has just one shape and sizes, which is green color, and maybe 500 rupees notes is a different color. And since I'm selling a product called money, the only thing which matters is cost of that money, right? And now you sell it in term of term loan, you sell it in terms of OD, invoice discounting, ABC, whatever you tell, it doesn't matter, right? You call it a structured finance, it doesn't matter. The end result is that the business needs the money, and they need it at the lowest cost of capital. Now, how you can bring that lowest cost of capital is what matters. Now, why I personally feel is cash flow based financing is a much better way. Is why I call the balance sheet underwriting is a stale biryani. And why stale biryani is, let's say if I'm looking of a business right now, I'm looking at this balance sheet which is audited last year, which is almost a year old balance sheet, right? And again, taking an analogy of 2007-8 crisis, and I was in US, and a lot of people lost their job, and they were sitting on a FICO score of 800, 750, 800. And everybody was like, we will only lend to like 750 and 800 FICO. And we as a bank decided we will not, because most of these 750 and 800 has lost the job, and they are not in a position to. So FICO is fundamentally what I say is a balance sheet, and salary is what I say is the cash flow. Cash flow is what tells you that whether the person is going to give you the next EMI or not, or whether the person is going to default. So that's where the cash flow becomes much more important, right? We have finance companies where the company has literally came to us and say that I have not even registered the company now, but I have got a contract from a large AAA rated company, and the contract worth like 3 to 4 crore. Now, if you finance me, because I know that no other bank will finance me. So if you finance me, then I will go register the company and take that contract. Will you do it? And we said, yes, why not? If the contract is from a AAA rated company, why not? Because the cash flow is going to come from a AAA rated company, right? I'm perfectly sure that it's going to come. And it did, right? Everything works like a charm on that, and they become our, customer till now. They are also our customers. So a lot of these things is mostly a mental block which banks has in terms of that. They don't ask the right question. And I went into a meeting with a lot of banks, and once there was a classic case that has happened where the CRO of a bank said that, Manish, I have my policy at 700 as CIBIL score. Now, the case that you have sent, the director CIBIL is 690, right? And people are fighting that, oh, so we have to take a policy deviation, all those things. But the right question to ask is, what is so magical about 700? If it has come from mathematical model, then it cannot be 700. It has to be 698.53 something, right? It can't be a round number, and that round 700, right? So people are not asking the right question. 700 has been set up because somebody felt that, yeah, let's make it 700. It looks much sexier, much better at that 700 rather than putting it 690, right? So a lot of these are mental block that we have created, and because of that, we said this is riskier, this is not riskier, right? And that is where we said there is a higher cost of capital. right? If with digital mode of acquisition, my cost of acquisition is reducing, my cost of underwriting is reducing, I'm getting a much better probability on the default. Why can't I reduce the cost of capital to a level which makes sense for the entire ecosystem, right? So that is needs to happen, but it possibly still takes some time. The UPI moment for lending still hasn't happened yet.
Yeah, excellent. Vasant, how do you think about those two things?
So we lend completely from our balance sheet, right? So I think for us, comparison with a bank in terms of cost of capital, all of that comes at an all point, right? Now I have a very strong belief that in good growing SMEs, the equity return expectations from them are 15-20%, which means any company, any corporate, any SME, there is enough opportunity to lend even up from a 8 to 15%, irrespective of size, as long as it's lower than their return on equity that is there. It's just that you need to identify suitable pockets which today no one else will lend to, because, for example, we don't look at a bank as a competitor. In fact, we don't go to a company where the bank is not lending. We don't go to unbanked, right? In fact, all our customers already have their banking limits. They still borrow from us at a higher cost because for whatever reasons, their banking limits are exhausted at their cost of capital that the bank. So believe that there is enough opportunity as long as you understand different pockets of supply chain and you are uniquely positioned to lend. I think there is enough pockets where you can make a spread much more than bank. Having said that, I think, yes, to some level, yes, your cost of capital does matter. But I think where we try to differentiate is that, see, there are two other things that matter, right? Ultimately, lending is about three businesses: cost of capital, your OPEX, and your credit quality. That's all, right? You just need to minimize all. If you can't minimize in cost of capital, you minimize in ensuring that you have so much data that you keep your gross NPAs and NPAs so low that if today they work at a 3% gross NPAs, we work at the 1% gross NPA. So because we have so much of real-time supply chain dynamic data coming in, it helps you keeping your credit costs really low. Two, our origination cost, which is also what Manish was talking. Today, our origination cost is 2.5% because we have a lot of digital origination as well as data that we constantly use to monitor. So today, our OPEX is 2.5%, which compared to even scaled NBFCs, that's very good, right? A cost to income ratio of less than 25% is quite good.
It's fantastic. Yeah.
Correct. So as long as you use your USP of tech data, your unique position in certain supply chains to keep your OPEX cost and your credit costs low, I believe that you can easily offset the lower credit cost that banks have. And there is enough opportunity in India to lend at any interest rate.
Maybe a follow-on question to you. If I'm a bank and I'm looking at you guys or Credex, why should I not play? I asked Naveen essentially that on the retail side, but asking you on the SME side, why shouldn't a bank come after this? Frankly, their cost of capital is low. I know the cost of the OPEX as of now is not there. But theoretically, a digital model could work and they could do exactly what you are saying.
I think what happens is today, I think that evolution would take 20 years, right? I think they follow a process that was set up 20 years back. Yes, they could probably get there. But then I think there's enough time for them to get there by the time you can see multiple other large companies being built out in that gap. Today, given their risk appetite, what happened in everyone knows 2015 to 2018, their focus continues to hold on asset-backed financing. It's also because they realize there is enough headroom for growth even in asset-backed financing. They don't realize the need to go here because even their stable conservative led lending practices itself is giving them enough headroom for growth. So it's not that the market is saturating that they would want to increase wallet share per customer. They would also organically to grow 20% year on year. There's enough way for them to grow itself. So hence, don't see too much of worry from that sort of going forward.
Makes sense. Madhu, coming back to you, the same question that I asked Manish on the SME side. How do you think cost of credit works on the retail side for you guys or for other players in general? because that's essentially one concern that we keep on hearing, that BNPL credit costs. If I look at now Australia, suddenly all the BNPL players seem to be in a little bit of spot of bother. What do you think is happening in India?
Sure. So see, cost of credit is a function of vintage, and your existence for the years. It's a function of your credit rating, what you could get onto your NBFCs, and so how much of banks, whether it is private or public sector banks, that are kind of backing you and whatnot, right? So one key thing what I see it is it's a vintage factor is a lot. Everyone wants to see the balance sheet vintage, or the quality of your loan book to be kind of there for about like 5-10 years, and a rating of A category and above is few of the things which definitely get your cost of funding lower, but definitely not as low as what the banks themselves raise it, because for whatsoever reason, the banks have the advantage of playing on the public deposits.
Yep.
which NBFCs like us can never basically have that, because we are a non-deposit taking NBFCs, and most of them are, and therefore we cannot leverage on the deposits what we can take from the public and then go to that kind of a cost of funding, right? So there is always going to be that parity. Now the overall idea is that how low that particular cost of funding can be kind of lowered, right? So now the way to look at this particular thing is that there is also, what I understand in the industry, is that there is a little bit of a herd mentality of your determining the pricing and the volume of lending that happens to a fintech or an NBFC. So there is a specific, like let's say there is an SBI bank which comes and underwrites you, then there is a follow-on banks from the public sectors what can come, and then you have a larger negotiation in terms of your pricing and whatnot. The similar thing happens on the private, it could be like Kotex or ICICIs of the world. If they have underwritten and then provided, our HDFCs of the world, right? So if they have underwritten and then provided, then there is a lineup of the private companies which are ready to lend at few bips lower than what they would have done. All right. So there is this is a factor very unique for Indian ecosystem, that there are few banks which underwrite the first time, and then that can kind of really drive your cost of funding going down, apart from the vintage of the companies itself. Now, I agree a lot to the point what was brought out by Vasant. The idea here is that, how much of this, whether this cost of funding itself is such a deterrent for the communities that we are serving, or the unbanked societies that we are serving, is that really a cost, concern? When we compare the pricing, what we basically do with the local money lenders, or any sorts of the short-term lending that was happening earlier, there is a huge advantage what the customers are already in, right? So now here, as he was mentioning, I think the other things what's kick in is how much of convenience are you providing for the customer, whether he is ready to pay a premium for that. For example, there is a customer who wants a 15,000, 25,000 rupees line of credit, or a personal loan. For that, if he has to go to a bank's branch for about like 3 or 4 times to sign the documents, the cost of his fuel and the time that he has to invest, can that be kind of definitely adjusted through a digital medium, where there's a slight premium to what he has to pay for that, right? So the convenience also kind of kicks in. And largely the overall credit cost, right? So your pricing is always determining of your cost of delivering the product, the cost of funds, the cost of your credit, right? So that leverage is much more stronger for companies to build upon. Definitely, there is no point in we trying to chase a cost of funding what banks can. By design, that cannot happen for an NBFC company. Of course, we leverage on equity in the initial stages, but on a scale model, the equity is going to last for only for some small time. Therefore, not to go and bang your head on, banker cost is smaller, so I have to get it to that level. There is certain parity which will always exist, and we should work on the other efficiencies.
Yeah.
If I can make a couple of small points on that point, on the question that you asked. See, if we see that the subprime model has been fairly well established at a very mature level in all developed markets. In India, we have access, or all the founders have access to what's happened there. And so it's an established market to be taken. We know that there is a huge amount of under penetration in India, and the fintechs technically have to beat the money lenders, as Madhu said, and do it profitably. So it's a very viable long-term model. There's no doubt about that. Of course, when things start from zero, there are some accidents that will happen while the creation is happening. Banks, of course, have a fear of basis the past experience which happened in a very different era, and hence they will go after it only very slowly. Uh, One of the risk, of course, is that if the venture capital funding etc. is too easy, we will see people doing non-viable practices, like whether you take cost of equity as zero while deciding to do lending, or whether you do lending at negative margins because you're trying to chase growth in the next round. But I think that's inevitable and part of building the ecosystem and the growth. The good players will find a very sustainable, profitable, risk-adjusted margin in this segment, and for a reasonable period of time that allows them the opportunity to become reasonably big before the banks also start to come in and start taking their share. They will take some share, but I think it'll allow certain companies to become reasonably significant in this area.
Yeah. And actually, that's a great segment. I mean, thank you for coming in. Maybe to Manish and you, a very simple question. If you have a crystal ball and you could look at it and figure out what's happening in the space in the next 5 to 7 years, Naveen, to you more on the retail side and Manish to you more on the SME side, how would you predict the market in the next 5-7 years? What do you think are two to three big themes that would start to become scale or start to happen? Manish, maybe we start with you.
I think on the MSME side, and in general about the business lending side, cash flow underwriting will become much more prominent, right? People will start realizing. I remember when we started, we have a hard time explaining people what is invoice discounting, and we have to do a lot of content and education just to explain. A lot of business used to tell us we also have an invoice discounting line, but when we see the sanction later, we realize it's just a business loan. So a lot of those things will change. A lot of business will also start appreciating, supply chain finance and invoice discounting in general more, because it's off balance sheet product rather than a on balance sheet product, right? So all those people will start asking questions which are more relevant and more important for the businesses to understand. What I realized in general working with a lot of MSMEs is there is a zeal to advance, a zeal to grow. And a lot of times they get bucked down by this finance requirement, which is there. In fact, I think 10 years back, RBI has came up with a report which says that if every company does the payment to each other on time, there is a 20% increase in profitability of all companies. So possibly we should charge that for 20% to everybody, saying that we are paying you on time. So, you rather, give that
some part of your increase.
Yeah, at least give me 20%, something to hear. But I think, again, I'm just saying possibly we will start seeing more UPI of lending coming into picture, where, there could be rails, which everybody will start working upon. And I keep on saying that there are few things which are very unique to startups and banks, right? So banks has their power of balance sheet, or power of that liability piece or the deposit, right, which makes them the lowest cost of capital. Fintech has their power as a power of tech, which makes their customer onboarding, customer experience, which Madhu and other people have also talked about. So that experience becomes too good. They should not look to each other as a competition. They should look to each other more as an enabler to each, right? I don't know why banks cannot get over this fact that somebody else can own the customer and still they can service them, right? Why this is this fundamental belief that I want to own the customer. Every time we talk like, can I meet the customer? Can I get a MOU signed with the customer? I mean, why it is important? Let me own the customer. And you own the, the balance sheet, you own the books of that. So I think possibly over some time, people will start going towards it. And, you asked previously that why banks cannot go into, what we are doing. Of course, banks are still trying to go into what we are doing. But in banking parlance, what we also say is concentration risk, right? So as a platform, we don't have a concentration risk. Banks will come and say, hey, sorry, I can only do this. So supply chain finance, vendor finance, all these things was there from like decades and decades.
Yeah, absolutely.
But they were only doing the same. Like, I want the cream of this anchor to be done. I don't want to go into the dirtier part of it, right? But when we go, we say we can take the dirtier part, we can take the cream part, we can take the entire part, right? So that is the benefit that we give to the corporate by working with us. So hopefully, a lot of business, banks and NBFCs will start warming up to the fact, and they say that, okay, let them own the customer, right? What Naveen said, that in UPI, what has happened on the consumer, that now almost 100% of the customer experience is owned by Google Pay or Phone Pay, but the underlying rail is still banking. Possibly we will see the same thing where, the fintechs like us will own the customers and underlying rail is still banking. And that's still good, right? We are generating so much float for the bank, so they're still happy because their CASA is still growing. They just need to be a little bit relaxed with the fintech and say that, yeah, okay, you own the customer, you do the onboarding, you do all the entire interface also.
The only other thing is they would ask for a little bit of margin as well, but
then it becomes a no risk taking lending, which is like, give me an FLDG and then I will give you the lending.
Yeah. Thanks, Manish. Naveen, coming back to you, some thoughts around what happens in 5-7 years on the retail side.
Yeah, Saurabh, I think most of the entrepreneurs are intrinsically very optimistic and positive. I'm in the same camp. So my sense is
the consultants are also quite optimistic. We have to
consultants have to be optimistic.
Founder has to be, otherwise we will not fund them.
So my view is that, we have only about, like I said in the beginning, we have only about 16 crore people who have any active credit right now in the country. That's only 11-12% of the population. That's going to grow without a doubt, because it's now already becoming very much easier and cheaper to deliver a credit product if you can understand the risk and the need and at the right price. So it's going to expand very fast. And I think Manish or Vasant used the term UPI moment in credit. Whoever used it, please take credit. But that's going to happen, I think, in the next 5 years. We're going to see rapid expansion in terms of new consumers, lots and lots of new consumers coming into the financial ecosystem. And as the credit bureau is becoming more mature, once you come into the system, it's like you're part of the club then. And then you start to get more and more access, more easier access. India as a country is growing at about 8%, 9%. And, over the next 5-7 years, our GDP per capita will grow from $2,000 to $4,000 or so. There will be a huge class of, somebody said, I think Madhu said, that 300-400 million new consumers who will come into this, consumerism or middle class kind of category, and they'll have wishes and demands, and they will need credit from time to time. So we're going to see multiple formats of credit, but a rapid expansion across credit. Couple of other things that will happen, and I hope they happen, and they'll drive and accelerate the financialization even more, is the democratization of data, account aggregator led or kind of digital banking led data coming together, becoming even more easily available. Imagine if AA was, live and mature and stable, and actually at a click of a button, you could get access to the financials. If we believe that more and more people come into the tax and GST framework, the data will start coming into system, and that will just make things more easier. And so I think it's probably the best time for somebody to be in financial services, fintech, across all categories, but specifically in lending.
Excellent. Basant, Madhu, any last thoughts before we wrap up?
Yeah, Madhu, you want to?
Yeah, sure. See, even today, if you look at the way the fintech models, or especially on the lending side, if you look at it, it's not just one balance sheet lender participating. There are platform models where there are in-house NBFCs, there are co-lending partners, and there are small finance banks which are participating. Just to give you an idea, on my balance sheet, probably there are 60 lenders who are there. And on my platform, there are about like 12-13 co-lending partners. Now, if you look at that, right, there are 70 players who are participating on that marketplace kind of a platform, and where we are lending to that one borrower, right? So the borrower the front end of it, he seems like this is one app which is doing it, but the back end scenes is much more complicated, evolved. There's a lot of partnerships that are happening. There are a lot of coexistence between the banks, NBFCs is already being seen, right? So now what I believe going forward is that, I mean, not 4 years back, I mean, the questions were at some extremes that is fintech a bubble? Matlab, fintech is just there for some time, and COVID kind of an event would, not even COVID kind of event, even a smaller event might wipe off this entire market. So that didn't happen. Now the other extreme was, the banks are going to kind of enter into this market way faster, and therefore so fintechs will not have any chance to kind of grow. I think these are all, and the one more extreme was, is fintech a challenger to a bank, and are the fintechs are going to replace the banks itself, was the other thoughts, right? So I think we have a very clear answer these days that it is going to be a coexistence. Right. So there are certain areas where banks excel. Definitely the balance sheet. Nobody can question the banks with the kind of balance sheet that they carry. In terms of the convenience, in terms of front ending to the customers, I think in terms of innovations, I guess it's the role of the fintechs that they're playing. So therefore, it will be a coexistence model, what will eventually kind of evolve much more stronger. And of course, some consolidation should definitely happen between banks and fintechs. That's also we would be able to see that. But coexistence, consolidation would be the way forward, is what I believe.
Right. Yeah. Vasant?
Completely agree. Coexistence is always that will happen. I remember last week reading a book by Uday Kotak, and he said that the first product that he ever launched was actually bill discounting. The first lending that Uday Kotak in 1980 or whatever that time, the first was bill discounting towards Tesco, the earlier Tata group of companies, right? And Manish clearly said that even today, 40 years hence, the penetration of bill discounting is hardly there. There is enough headroom for growth. So fundamentally believe that there is enough headroom for growth and everyone will sort of coexist. But I think just one thing, we have spoken so much about lending, but I think the reality is that lending is a business of collection, right? So as long as that sort of appreciation and understanding that it's not about giving money, but it's about collecting money is there, I think there is enough headroom for growth for sort of everyone out there.
Excellent. Thank you, everyone. I learned a lot personally. And Manish, I think what Vasant said, what Mr. Kotak did 40 years back is now for both of you to take ahead. But super to be here, and thank you for your time. Thank you so much for tuning into ET India Inc. Boardroom. Stay tuned for more.